Hi, this week we have three webinars that can be very interesting to you. First is Emperor Decoded, the story of Indigo at 11 am in the morning. Second is we have Why Milestones to Wealth, that is YM2W at 12 pm in the noon. And third is 401k Rebalancing at 7:30 pm in the evening, that is 10 am EDT. So please register and join these webinars without fail. Thank you.
Hi everyone, welcome to this episode of Talking Straight with Shyam Sekhar. We have a series of questions that we asked Mr. Shyam, and without much ado, let's get straight into the series. Hi sir, you've been investing for well over 3 decades now, navigating both bull and bear markets. Has there ever been a situation where there was a moment of fear or panic? And if so, how did you manage these situations and emotions, and what did you learn from it?
There will always be moments of panic. The first big moment of panic that I can think of was when we heard that Harshil Mehta had defrauded Indian banks to manipulate the stock markets. That raised a lot of uncertainty in 1992. The next one was the 2000 tech crash. I think that was terrible because we had not invested in tech companies. We had taken all the precautions to avoid expensive companies. But when the markets fell, the conservative value stocks, which we bought using the principles of Ben Graham, fell further. So at that time, it was quite shocking because we had bought a value portfolio and that went down by half. That was the second. 9/11 was the third because we had never thought of a terror attack that would traumatize the whole world. And it happened in front of our eyes. It's not something that happens very distantly, which you read in the newspapers. It happened right in front of our eyes. That was the era of global television. So 9/11 was the next one. And the fourth one that I could think of is the global financial crisis. Here again, we had not thought how deeply the impact would be felt in India. Because we think that the financial crisis in the United States is something that will function in isolation. But in a connected world, the kind of impact it had on India was something that surprised us. So whenever these kind of incidents happen, you will tend to feel deep fear. I also recall the COVID lockdown and the global collapse in the stock markets as probably the peak moment of such fear. There will always be moments to fear, but whenever fear spikes, you will have to calm yourself down, be more composed, collect yourself, and then ask yourself, what is it that I can do? How much worse can it get? If it can get worse from here, what can I do? Do I have a response? Can I create a response to such a situation and wait? And should I wait for that moment when it will get much worse? Or can I do something now and along the way when it gets worse? Because I don't know how much worse it can get. So let me keep doing something and at least participate and not be a spectator. One thing that I would say common to all these moments of heightened fear and panic is that I followed the same rehearsed approach almost in every situation. With every episode, because these are all episodic in one's life, you also become a little bit more experienced in dealing with such situations. So you will know what you did last time and how it played out. You will know what is best to do in such a moment. You will know what to avoid. So with each passing episode, your response to that panic situation becomes a little bit more rehearsed and more convincing. And you also tend to move on. You don't freeze. That's the most important thing in these situations. So what all these situations tested me was whether I could move on or whether I would freeze. I would think in almost all the situations I have moved on, but I would think that my response to COVID was a tad slower than the other situations because we also had the physical restriction of being unable to move. So that was something that had a slightly higher psychological impact. But I wasn't this much affected even in 9/11 or GFC. In such situations, we just moved on in life and, first protected yourself, kept doing incremental actions every single day, And as those incremental actions started raising our confidence, we became bolder in our response to the crisis. So basically, the response starts with incremental actions, which are first defensive. And when the defensive actions work out, you start doing things in offense. So basically, it's a defense leading into an offense. That is the general pattern that I would say pervaded through each of these crises. It's not one crisis, multiple crises.
So right now, there are a lot of geopolitical tensions that's happening around the world, and geopolitical events tend to impact the market faster than ever. How do you see the current geopolitical tensions affecting the Indian markets in the short and long term?
Every geopolitical tension will reflect in our economy. The first port of call for a geopolitical tension is in oil price, because India is a net importer of oil. The next is in our exchange rate, because exchange rate immediately sees stress. The third is in inflation, because we could see cost spiral. These three things generally are the first three ports of call. After that, you have commodity prices, because India manufactures a lot of commodities. India also adds value to commodities. Increasingly, we are transitioning from a manufacturer of commodities to a manufacturing value adder of commodities. So these are the places where you will see an immediate impact, and one has to constantly size up this impact. For example, we saw the GFC. GFC saw oil price crash from something like 148 to 40 or something like that, right? Dollars per barrel. Such a crash will affect the listed companies like Reliance, IOC, all these big companies, because they have to take an inventory loss. So immediately you will see that there could be an impact on the earnings of the Nifty. There could be something like that. So commodity prices tend to impact India's large companies significantly. For example, if steel prices collapse, then we have a few steel companies in the index. Those companies will be affected. Similarly, if interest rates are forced to go up, then the automobile companies will struggle to sell volumes. So volumes may suddenly contract. Also, commodity price going up will affect the margins of industries like automobiles. So you will have to size up what that impact would be. So every crisis will reflect in different places. The intensity of that may vary. If you see, in the 90s, a war would trigger a collapse in the stock market, because we will fear what will happen to oil prices. Today, because America is self-sufficient in oil due to their shale assets and their long-term oil security strategies, the world knows that it's only the problem of the other countries to manage their oil sufficiency. Geopolitically, the two large countries after America which import oil, China and India, have their own relationships with their supplier nations. And America is not too bothered or interfering in these equations. That's why we were able to buy oil so cheap from Russia. Whereas in the earlier instances, we had to go and buy from Iraq or some other countries who are our friendly countries after a lot of difficulties. Now, that's not the case. So, the oil sensitivity to the markets has actually come down progressively. I would think that if you are able to produce non-conventional energy significantly, and if automobile shifts with every decade more towards electric vehicles, I think this oil intensity will come down further. So, geopolitical tension centered around oil seems to be slowly on the wane. That's what I am thinking. Also, there is this realization in the minds of a lot of people that war is not sustainable, and war is not economically viable for most nations. But that's not how people think of war when they want to wage it. But the market view seems to simplify it. So, if you see, Ukraine has been going on for such a long time. I think, but for the first few days, the world has stopped being bothered about Ukraine. It has become a kind of a sideshow. But having said that, we can't say that the same reaction will come if you will have a war involving multiple nations. For instance, if there is a sudden rogue attack by one country on another, and then that country retaliates on a third country, and the third country in turn retaliates on a fourth country, if you have something like that, then there could be a lot of confusion. But for the moment, I think we have simplified these things to assume that they are not sustainable. we'll have to see what happens in the subsequent geopolitical conflicts that we observe. But as of now, we seem to not worry like we used to do before.
So, should any of this bring a change in the investor strategy in terms of their investments?
See, whenever there is a geopolitical conflict, the investor looks to use the conflict to buy businesses which are not affected by the conflict, but whose stock prices seem to have taken a hit. For example, you may have some industries which are completely domestic facing, which have no imports, which have no exports, and where domestic demand is fairly safe and growth is certain to happen no matter what happens to the geopolitical conflict. If those stocks fall significantly, you should buy them. You should follow the same approach whenever you see a conflict. Pick businesses which are insulated from the conflict, isolated from the consequences, and likely to perform sense of stability in their business. You can buy those companies or those industries. So, when there is a conflict, you focus on the place where you want to focus, which is probably not that much affected by the conflict, but is showing a stock price change which reflects a lot of risk. So, when the stock price responds to something purely out of emotion and you find there is no reason, then you go in there and buy. That's what you can do.
So my next question is, what is your take on international market exposure? What are the sectors or international markets that seem appealing to you now, and what would you advise to staying away from?
Increasingly, I have been studying international markets far more closely than in the past. The reason is that I think that our markets are also moving towards more new age businesses, new economy businesses, and the best place to see how these businesses have performed, to understand them better, is in the international market. These new age businesses and new economy businesses are more in an early stage in India, whereas they are in the growth stage or in a mature stage in the West. There are many of these companies which are today listed in the US but are not listed in India. For instance, you don't have electric vehicle companies except Tata Motors, which are actually listed in India and having a significant size or scale. But you do have a number of companies in the EV space outside. Similarly with renewables, you have companies outside, you don't have them here. Companies which produce inputs for many of these new age industries, you have them outside, you don't have them in India. So when you go out, you get an opportunity not only to understand these businesses, like if you want to invest in lithium, you can go and invest outside. You get to understand the business, you also get to invest in them. Here you are probably not having that opportunity. So where you are not having direct opportunities here, you are able to go outside and invest. And in new age industries, these opportunities are huge. For example, a cab hailing service like Uber is an opportunity you don't get to play in India. So you get that opportunity outside. You all like going to cafes, but you don't have a business that is listed in India which runs a chain of cafes. But you can go outside and invest in Starbucks or in several other companies. Similarly, in QSR, you have very, very large companies outside in which you can invest. Whereas in India, you have a few companies which are not really big plays, where the scale is not so respectable, which are still in a very early stage. So what you cannot do here, you can do outside. Where you cannot invest in India, you can invest in the same thing through an overseas company. And you also get the exposure of these industries much before they list in India. So if you go abroad and do it, you are already ready to invest in these industries when they list in India. I think this is a big boon now compared to in the past. And because of this, I think I am able to study a number of new industries, a number of new companies, and a number of new teams where I can develop an understanding and also participate. So in that sense, investing abroad is very, very critical because it's very good for gaining experience and also evolving as an investor. That is the major upside in investing abroad, and that is the reason I look forward to continuously investing abroad.
The question about what looks appealing to you now and what the countries that you're staying away from, do you want to answer it?
Well, I liked some parts of the US market for quite some time, very specific bottom up, like Starbucks, like Crocs, like Airbnb. I'm looking at the travel space again outside India. I also liked the QSR chain, some of them. I think that footwear is another business outside India, which is very, very attractively valued. Our domestic business is extremely overvalued. Stocks here are all 50, 80 PE. There you're getting high single digit or low double digit PE stocks, which are growing decently and which are likely to come back also if they're down. So there's a lot of value in the US markets owing to these corrections. In fact, during the COVID crisis, I managed to invest in Meta when people doubted Meta. But Meta has done extremely well today. Similarly, I invested in Amazon when the stocks were really down in the COVID crisis. So some of these companies have been extremely good not only for investing and getting returns, but also tracking and understanding these businesses. I think there's a closer connect today with the Western markets as an investor. And I think this connect will only grow going forward.
We shall continue the discussion going in the second part of the same episode.